Hello everyone, welcome back. After a long time I'm coming. I took a gap of 2-3 days. In between I didn't make any videos. So after a long time I'm back. Sorry for the delay, but I was actually sick. I was sick, that's why I couldn't make. So now I came. My voice was gone totally. I have now little of voice left in me, so I'm sorry for the delay. Right? I was having fever and then I was very sick, so I couldn't upload the videos on time. So sorry for the delay. Now let's start with question 53. This is exchange rate. We have mixture of exchange rate, net present value, mixture of everything in this question 53. Let us read it. As you can see, you are given spot, forward, you are given future, you are given options. Okay, and then looks like that this is an international net present value. So quite a lot. As you can see the requirement, there are so many requirements. Oh my god. It's very easy to panic at this time, so don't panic. What you have to do is handle one requirement at a time, deal one requirement at a time when you answer. I know it's very lengthy, so you might tend to panic and get a shock what the hell is going on, but don't do that. You need to be calm and break the big piece of information into small pieces. That's how you deal with questions like this. Starting with A, discuss how investing in overseas projects may enable Washi to gain competitive advantage over its competitors who only invest in domestic projects. So this is like, it's quite easy. You just have to say the advantages of investing internationally versus the one who only has investments in domestic projects. Okay. Part A is like a theory question. Coming to B, discuss the advantages and drawbacks of exchange trade option contracts compared with over the counter options. This is also a theory part and it would be quite easy for you to handle it. So 10 marks is just for theory part. Coming to part C, prepare a report for the board of directors of Washi company, which, so C is report for the board of directors. Three things you have to do in this report. First, we have part D also. Okay, estimate the expected amount of Japanese yen receivable under each hedge choice. And so this is a receivable, foreign currency receivable, and under each hedge you have to estimate the amount and the additional debt finance needed to fund the Aeron project for the preferred hedge choice. That means out of the all the hedging methods which you use, you have to choose. So this question is little different. It's not like give conclusion which one is the best hedging strategy, and no, you have to select one hedging strategy, and based on that you have to find out what is the additional debt finance needed to fund the Aeron project. Air One project. Okay, so additional debt finance to fund this project for the preferred head choice. That means you have to prefer one head choice only. Based on that only, your debt finance will differ. Of course, you have to, since this is a receivable, foreign currency receivable. So when you choose a hedging, you have to choose the one which is giving you the highest receipt. Coming to point second, estimate the net present value of the Air One project in Japanese yen. So this is a question of your net present value, exchange rate risk, and also a little bit of theory also. In Japanese yen, they have told you the currency. Based on the end of year one being the start of the project, year zero. So end of year one is, we are considering it as the start of the project. 9 marks. Then come to evaluate the preferred head choice make, the debt finance needed, and whether the Air One project should be undertaken considering both financial and non-financial factors. Now you have to be very careful. So financial factors you'll be able to tell. Net present value is this, under hedging this one we are receiving this, that. All this you will be able to talk. Non-financial factors, you have to work on your non-financial factors. How will you do it? Just go through your answers. You must have gone through many questions by now. You have practiced. There are so many theory parts. You can pick up points from each question. You can pick up points. What are the non-financial factors which can affect this? Okay. So this has a lot of requirements in one requirement. You have to evaluate the preferred head choice. Okay, preferred head choice, evaluate, that means pros and cons. Evaluate means pros and cons. Okay, the debt finance needed. You have to evaluate not only the hedge, why you choose that, what are the advantages and disadvantages of choosing that hedge which you choose in the first one, and also the debt finance needed. You have to evaluate, and whether the company should be undertaken or not. You have to give both financial and non-financial factors. And professional marks is there for the formal structure and presentation of report. Coming to point D, Washi company's chief operation officer has suggested that it would be more beneficial for the company to let its major subsidiary companies have their own individual treasury department. Instead of having one centralized treasury department for the whole company, discuss the validity of the COO suggestion. Now, one thing I want to tell you is under risk management, you have to be prepared for this treasury department, their role, their job. Centralized versus decentralized treasury department, which one is better? The advantages and disadvantages of each. This is a very common question. I even myself I got this question in my exam, and this has been repeated many times. The treasury department's roles, especially centralized versus decentralized treasury department. So mark it somewhere and learn the theory part of it. You will not be asked a calculation, but the theory part will be asked in risk management. More beneficial, own individual treasury or centralized treasury department? Centralized, as the word says, it is centralized one treasury department for whole. Individual treasury means each department is having their own separate treasurers who controls it. So you have to talk about advantages and disadvantages and see whether the CEO suggestion is valid or not, because they are saying it is more beneficial. Now this type of question is your own opinion. There is no right and wrong. It can be thus. You can either validate or you can say it is invalid, provided you give the correct reasons. So now we are coming to the case. Washi Company is a large unlisted company based in Japan, and its local currency is the Japanese yen. Okay. So what type of company it is? It is unlisted and it is based in Japan. So local currency is Japanese yen. This is the local currency. It manufactures industrial equipment and parts. Initially, Washi Company's customers consisted of other Japanese companies. But over the last 12 years, it has expanded into overseas markets and also sources its materials from around the world. The company's board of directors believes that the strategy of overseas investment through subsidiary companies, branches, and joint ventures. See, there are many ways of setting up overseas investment. Okay, you can either acquire a subsidiary there or a branch. You can have a different branch in another country or joint venture. Okay, has directly led to the company's substantial increase in value in the past few years. So first paragraph is telling you because of that international investment overseas through branches, subsidiaries, joint ventures, their value increased a lot. Coming to second paragraph, Washi Company's board of directors considering investing in a project based in Air 1 whose currency is Air on rent. It believes that the project will be an important addition to the company's portfolio of investments because Washi Company does not currently have a significant presence in the part of the world where Air 1 is located. It is intended that the project will commence in 1 year's time. Details of the project are given below. Okay. So one qualitative factor we have read in the requirement that we have to do qualitative non-financial factors also whether it is beneficial to invest in Air 1 project or not. So this could be one reason that they currently does not have a significant presence here. Okay, Washing company intends to finance the project. Always be very careful how a company is financing accusation, financing their investment in a project, how they are financing it. Are they taking equity? Are they taking debt? Are they taking right share? What are they doing? Are they taking bonds? You have to be very, very careful of that part. So they intend to finance the project, Air 1 project, through proceeds from an agreed sale of a small European subsidiary. Through proceeds from an agreed sale of a small European subsidiary. So they are going to sell their small European subsidiary, and whatever the amount money they are going to get from that sale, they are going to invest in the Air 1 project. That's how they are going to fund. With any remaining funding requirement being met by additional debt finance. So whatever is left, if it is value is not able to cover the whole of the Air One's project's investment, then they are going to go for an additional debt finance issued in Japanese yen. So the debt finance is issued in Japanese yen. One good thing is it reduces exchange rate risk. There's no exchange rate risk because same currency only. The company is due to receive the proceeds from the sale of an European subsidiary in 6 months' time, and it will invest these funds in short-dated Japanese treasury bills for further 6 months before they are needed for the project. So they are going to receive the proceeds from European subsidiary in 6 months' time and invest in short-dated Japanese bill for further 6 months before they are needed for the project. Washi company has a centralized treasury department which hedges. So currently what do they have? They have centralized treasury department. But in our requirement, they are saying that it is better to have separate treasury department for each individual departments. It will be more beneficial, which hedges expected future cash flows against currency fluctuations. Funding and financial information. So the agreed proceeds from the sale of the European subsidiary become receivable in 6 months' time are euro 80. So this is the amount they want to receive in 6 months' time. The board of directors is concerned about a negative fluctuation in the rate between now and in 6 months' time, where the 80 million euro will be received. Therefore, it has asked the Washi company's treasury department to hedge the expected receipt using one of the currency forward, currency future, exchange traded, currency future option. So these are the three hedging instruments we have: forward, options, and future. We have to select one. Washi company's treasury department has obtained the following information. So you have been given the spot rate, you have been given the 6-month forward rate, you have been given the future. You have to select 4-month or 7-month expiry. Even for options we have to select, and also by the call or put. And for future we have to decide whether we are buying or we are selling it. Okay, so we are given an annualized yield on a short dated Japanese treasury bills. Air One's annual inflation rate is 9. See, whenever inflation rate of two countries given, this is an international investment. That means we have to find international net present value. You are given an annual inflation rate. Why that annual inflation is given to you? For you to predict exchange rates, or for your cash flow, to inflate your cash flow. One of the two reasons. But since we can see that exchange rate is given here, so you can convert, you don't have to predict. But yes, it is for how many years? Depending on the year project, you have to predict exchanges for each year. So then you need the inflation rate, right? That is known as purchasing power parity. Using that, we need the inflation rate of the two countries to predict exchange rates. So Air One's inflation is 9%, but has fluctuated market in the last 5 years. The Japanese inflation is 1.5% and has been stable for many years. Pato Bank has offered Washi the possibility of using over-the-counter options to hedge the euro receipt instead of exchange-traded currency options. It is over-the-counter option. What is the difference between over-the-counter and exchange-traded options? You have to answer this in your recommend B. Air One project information. A member of Washi company's finance team. Now see, you have an option in like this. Now you can read the whole case study and then start answering your recommend one by one, or you can stop at this stage and at least answer your because you might forget, right? If you read, you can answer your first two requirements. First two requirements you can answer, and you can even start hedging also. Hedging that 80 million euros without taking into account the Air One's project. Or you can read the whole case study and then answer. But we'll read the whole thing and then we'll answer. So a member of Washi company's finance team has produced the following estimates of Air One project, which is expected to last for 4 years. So that means exchange rate is needed for the 4 years. The estimates are based on the notes given below, but not on further information. Okay, not on further information. It is given on the notes given below. The estimates have been checked and verified independently for their numerical accuracy. So now it has been verified independently and checked for their numerical accuracy. Why you need all these assumptions? You need to talk about your assumptions and all, even though they didn't clearly say, but you need to talk. at least in your conclusion of the report. So all figures are in what currency? This currency, but you have to find net present value in what currency? Japanese yen. Japanese yen is your local currency. But first you have to find in Air 1 rent currency, and then you have to convert that net present value to your Japanese yen. Okay, so we have sales revenue, cost, tax allowable depreciation, pre-tax profit, tax allowable depreciation, working capital, investment in building and machinery, and cash flows in this. Notes incorporated into the estimates above. Further information not incorporated into the estimates above. So let's read the number 1. The estimates are based on using the end of the first year when the project commences as the start of the project. The numbers are given in ARD million. The total investment required for the project is ARD 10150, this one. Okay, this includes your working capital, investment in building and machinery. Together, that is your total investment. And separate into business machinery and working capital in the table above. The machinery is eligible for tax allowable depreciation on a straight line basis, and the working capital is redeemable at the end of the project. That means it is recoverable. Yes, we can see just like this. And also we have tax allowable depreciation, as you can see, 1000. Because straight line basis for 4000, right? 4000 divided by 4, 1000. Coming to point 3, the impact of the inflation has been incorporated into the sales revenue and cost figure. So it has already been inflected, so no need to worry about it. At Air1's current annual inflation figure. 4, corporation tax has been included based on Air1's annual rate of 15%. The tax is payable in the year that the tax liability arises. Coming to further information. Further information is not incorporated into the estimate above. That means this further information are your adjustments. You need to do these adjustments in that cash flow. Okay, undertaking the Air 1 project will result in lost sales for Washi. This sales would have been generated a pre-tax contribution. So what is the lost sale? Lost sale to this? It's like an opportunity cost for Washi company, right? Because they're investing in Air 1 project, they're going to lose that sale. So you have to find it. You have been given the pre-tax contribution in the first year of the project. You have to find for post-tax, rising by the Japanese rate of inflation. So this 110 is for the first year. You have to increase this by your inflation. Rising by Japanese inflation in the following years, 2 to 4 of the project. Coming to point 2, the Air 1 project costs include components which are made in Japan by Washi and would be imported into the Air 1 project. The pre-inflation revenue generated from the sale of components are estimated to be as follows. So these are the pre-inflation revenue generated from the sale of component. Okay, pre-inflation is just before inflation. This revenue is expected to increase by the Japanese rate of inflation. So from year 2 to 4 you have to increase by the inflation. The contribution which Washing company expects to earn on this component is 25% of the revenue. Coming to point 3, Japanese annual corporation tax rate is 30%. So Japanese tax is 30% and taxes payable in the year that the tax liability arises, same as airborne. A bilateral tax treaty exists between Japan and Air1 which permits offset of overseas tax against any Japanese tax liability and overseas earnings. Okay. Washing company's finance department has estimated a cost of capital of 12%. Yes, cost of capital you need. Why? Discount factor. You have to discount to find the net present value. So that is the cost of capital to be used as a discount rate for the project. Now, coming to the requirements again. So first is advantages of investing overseas compared to just domestic projects. 5 marks. We'll see how it is. I can quickly go through that. I'm not going to waste so much of time in that. It's very easy. But just for your understanding, some points which I want to bring to your attention because this is a theory question and you might not know how to answer theory question. That's why I'm discussing this in the videos. Otherwise, I could have just skipped. So if you see this is for 5 marks. So that means at least 5 points you have to give. Okay. In 5 different paragraphs. Usually the first line is just the introduction. Like here, Washing company may want to invest in overseas project for a number of reasons which will result in competitive advantage for it, for example. Okay. So what is it? Okay, investing overseas may give Washi access to new market and enable it to develop a market for its products in location where none existed before. So one thing is access to new market. Before involved in marketing and selling products in overseas market may also help in gaining an understanding of the needs of customers which it may not have had even mail exported its product. Okay. So the same point only they're explaining it. But the main thing is access to new market. Now they can understand customers and their supplier better rather than just exporting. Investing overseas may give Washi easier and cheaper access to raw materials it needs. Easier and cheaper access to raw materials. It would therefore make good strategic sense for it to undertake the overseas investment. Third, investing in projects internationally may give Washi company. Just see how they are linking to the Washi company every time they are talking. Advantages to Washi company, advantages to Washi company. So don't try to give, I know the benefits are general, but don't give general. Like don't exclude that name, don't ignore the name of the company. In every advantage, every bullet point or every point you make, not bullet point, write the name of the company in any question. Every question you have to do like this. So give access to cheaper labor resources or access to expertise which may not be readily available in Japan. Cheaper labor resource or expertise. Yes, staff. You can get skilled and talented staff overseas which may not be available in Japan. So basically when you learn, just learn the points. Okay, access to new market. Easier, cheaper access to raw material. Easier access to new talent. So these are the points you have to memorize. That's it. Sentences that you will be creating in the exam. That's your creation. How you are going to make that point and elaborate and write it. But don't spend so much of time also on elaborating one point because this is just for 5 marks and 5 marks means 5 into 1.8 only 9 minutes. More than 9 minutes you should not spend on party. Now, if you want, you can skip A, B and directly go to C and start doing C also. That is also acceptable. So you can do it in any order because A, B is not linked to part C. It's not linked. But yes, your C and D is linked. Sorry, not D. Yeah, your C is all the 4 questions are standalone questions. But D, of course, C you have to do after B because you have to choose a hedging strategy. So yeah. This could therefore lead to reduction in cost and give Washi an edge against its competitor. Okay, closer proximity to market. Raw materials and labor resources may be enable Washi to reduce its cost. For example, transportation and other costs related to logistics may reduce if products are manufactured close to the markets where they are sold. Okay, so one is closer proximity to market also. Risks such as economic risk resulting from long-term currency fluctuation may reduce where cost and revenues are matched and therefore naturally hedged. Economic risk is reduced. Okay, because your cost and revenues will be in that currency. So you don't have to deal with that exchange, that it is naturally hedged. Same currency, right? Your cost and revenue are in that currency or that country's currency. So washing company may increase its reputation based because it is based in the country within which it trades, leading to a competitive advantage against its rivals. So one is increased competition, reputation. But just make sure here in this answer there are more than 5 points. But you have to just write 5 points when you are practicing also. You don't have to include all these points. This is for your understanding purpose. Because some of you, let's say some of you might have put economic risk. Okay, all the points till economic risk. Some of you might have not included economic risk, some of you might have put reputation. So all the possible answers are here for you to check yourself with the answer. That's why all the answers are included. But real exam answers are not this long. So international investments might reduce both unsystematic and systematic risk for Washi company for if shareholders only hold well diversified portfolios in domestic markets but not internationally. Reduce both unsystematic and systematic risk. Okay, and you have to build up on that. You need to explain how. Coming to part B, advantages and disadvantages. Exchange traded and over the counter. Okay, this is also 5 marks. So advantages, clearly write advantages as a different subheading, disadvantages as a different subheading. Don't put your advantages and disadvantages in one whole paragraph. You should never do that. So exchange traded options are readily available on the financial markets. Exchange is readily available. Their price and contract details, their contract details are transparent. And there is no need to negotiate this, no need to negotiate in exchange traded. Greater transparency and tight regulations can make exchange trade options less risky. It is less risky. Why? It is more transparent, it is more regulated. For this reason, exchange traded options transaction cost can be lower. Option buyer can sell or close the option before expiry. American style options can be exercised anytime before expiry, and most traded options, American style options, where over the counter options tend to be European style options. Now coming to the disadvantages. The maturity date and the contract size for the exchange traded options are fixed. So maturity date and the contract size is fixed, right? We have 62,500 of pound of future, of option, or the maturity date. It is what? It is for 3 months only you can take option in exchange traded. It's a fixed. Whereas over the counter options, as you can see, this is we have 4 month expiry, 7 month expiry, because this is over the counter. They can be tailored. So over the counter can be tailored to the needs, customized. Exchange traded options tend to be shorter terms. So if the long term options are needed, they will probably need to be over the counter. Yes, they are shorter terms. A wide range of products, for example, a greater choice of currencies is normally available in over the counter options. Greater choice of currencies is there in over the counter. Exchange traded option does not have all the currencies, limited currencies. Coming to part C. So you are starting to write your introduction, report to whom, from, subject, date, introduction, everything. So report to the board of directors of Washi company and your introduction. Introduction, if you see, is just 3 lines. Sometimes it is just 2 lines also. So this report evaluates whether or not Washi company should invest in the AFM project and the amount of debt finance required of this million. In Appendix 1, right? If you want, you can put that amount, or if you don't want, don't put that amount in the introduction. You can put it later also. Because usually we don't put in the introduction, because to put in the introduction we have to do workings, right? Usually we write the introduction and then we start working on the other parts. So this is your choice, because we have a separate section where we are going to write what is that debt finance required. So there you can work it out, but if you want you can write it in the introduction as well, but make sure in that case you have to do your calculations first. Your workings under your appendix has to be done first before you write the introduction to write this figure. Okay, to fund the project. And the evaluation considers both financial and non-financial factors. Very brief, to the point. Next, evaluation of the preferred head choice and the debt finance required. You have to find what is the preferred head choice and debt finance required. Two things are required here. So we are going to work out. But before we write this report, okay, I'm just taking you through the report and then we'll go to the workings first. Because of course you cannot write the report without doing your calculation part. So now we are going to keep space. We are going to keep it blank. Evaluation of the AFM project. This is the next subheading. Then your conclusion and recommendation. Then your report compiled by date appendices. So Appendix 1 is what Japan is here receivable from sale of European subsidiary under each hedging choice and additional debt finance needed to fund the AFM project. First, we are going to use forward. Okay. We are going to use forward. So which rate are we going to use for forward? Let's start with forward. Okay. Forget about everything. Forget about AFM project. Everything, just when you answer questions, now you are answering. Calculation and all. All day look at one thing, forward. Now you're working for forward, so all day think about that, forget about everything else. For option feature. The more you think and try to think about everything, you will get more confused and do the forward also wrong. Okay. So let's look at forward. 6 month forward. Which rate are you taking? 125.3 or 128.6? This is what? This is 80 euro. This is a receipt. You are getting a receipt. Okay. So you are getting an euro means, okay, you have to sell euro, because if you sell euro only you can buy Japanese yen. So you are selling euro. You are selling euro means you are selling euro at a lower rate, because always remember you are at the worst position. The bank is the one who is making profit. you are selling at a lower price, or you can say you are selling means the bank is buying from you. So bank will be buying at this rate, 125.3. Okay, so the rate is 125.3. So now let's see here. So since it is a euro receipt, the lock, okay, always write this thing, whether it's a receipt or a payment, and then write the rate. Why you have choose the rate? You don't have to say that the bank is going to buy, we are going to sell at a lower price. No, you don't have to explain all this thing. You just have to write this is an euro receipt or this is an euro payment. If it's a payment, this is the rate. If this is a receipt, this is the rate. That's it. So the lock-in rate of Japan is this one. Per euro will be used. Simple. Next, just convert using your rate. So what is it? Expected receipt from the sale. Multiplication. Why multiplication? Different currency. Because this is 80, this is in euro, and this is in Japanese yen. If you see, different currency always multiply, same currency divide, and then you are getting in Japanese yen. Keep it, and don't forget to write this million at the end, by the way. It's very important, because what some of you do is, some you write million, in some you forget to write million, then it's very confused to compare the figure. So always keep the currency same currency. Make sure under forward, future, and options you have in the same currency. Million is there. Okay, and one more thing, if you get confused in writing decimal 80 million, let's say 80 million when you multiply by 125.3, okay, or you might get confused with the number of zeros, then it's always better to write the whole number like this. 80 million means 6 zeros will be there, 1 2 3 1 2 3 into 125.3, and you can write the whole number. But it's a waste of time, of course. You have to write so many zeros and all. Try to write this just for those who are confused with the zeros and point. Now coming to future contract. Future contract, you need to decide which expiry date you have to choose and whether you are buying or selling. You have to decide. Okay, that you have to tell. Whether we are buying or selling. So let's go to future first. Now, what are we doing for future? Now forget about forward and everything. Look at future. 4-month expiry or 7-month expiry. Look at the size. Okay, we are receiving it in 6 months time. That means your period duration is for 6 months. You have to hedge. So you cannot use 4-month expiry. You have to use a longer one. 7-month expiry. So you are choosing 7-month expiry. That means this rate. Okay, you also have to find the number of contracts using this. You're buying or selling. You are going short or you are going long. What you are doing? We are buying or we are selling euro. We are receiving euro. We have to sell that foreign currency, because when we sell that foreign currency only we can get Japanese. Buy Japanese yen. So we are selling euro. Because look at the euro contract size is also in euro. So that means we can sell in euro. Euro we are selling means we are going short in the future. Okay. So the future contracts need to show a gain when the euro depreciates against the yen. Therefore, short position is needed. Using the 7-month short position is needed. 7-month. You have to write 1 mark you are getting to write that it's a short position. Another 1 mark you are getting to write that 7-month contract. Another mark you are getting to find the closing future price basis risk. Another mark you are getting to what? You are getting points for everything, dear. You cannot even ignore one sentence also, you cannot miss. If you are not finding number of contracts, you are losing 1 mark. If you are not writing that 7-month contract, yes, you are using the rate correctly. You know that you have to use 7-month expiry, but you are not writing as a sentence. You are not getting that 1 mark. You are losing it. Even the most obvious thing, you have to write it. You cannot just assume that the examiner will know, or I have used this rate, so they will know that I have used this expiry only. No. It is assumed that basis will depreciate proportionally to the time expired. This assumption is always fixed. Okay, this is fixed only for future. There is no other assumption. So this you can memorize it also. The reason why they have told this is because in this usually they tell that basis is assumed to be depreciated proportionally to the time expired, but here they didn't say. So wherever they don't tell, you have to write that assumption. I told you stated assumptions, because you have to find basis risk, you have to find the closing future price. So that assumption they didn't state, you have to state. If they have stated, then you don't have to state it again. Okay, now the first line, what does it mean? The future contracts need to show a gain. What does it mean? It means that whenever you take a future, why do we take a future? To have a gain only. We never have a future to have a loss. That means if we take a future and we are getting a gain in the future, in the spot market we are having a loss. It's an opposite relationship. In the future we are having a gain, we are making a gain, but in the spot market we have making a loss. If we are making a loss in the future market, we are making a gain in what? Spot market. So it is offset, right? How we are going to have that gain in the future market? When the euro depreciates against the yen. Okay, make sure that you understand this point also. Euro depreciates against yen. This is the receipt. So after you convert to yen, you should always have a higher gain, higher receipt. If you are not having a higher receipt, then it's a risk. Then you have to hedge. Okay. Predicted future rate. Now, what is the future predicted rate? Now, if you see, there are two ways. This is number one, this is number two. There are two ways of predicting future rates. You don't have to use both. You just have to know any one of them. Okay, but the answer you will get same only. Okay. Now, I believe that the second method is easier because it is the same method which is there in your textbook also. The second method. So I will first start with second method and I will also explain you the first method as well for those who feels more comfortable with the first method. Okay, but I always go with the second method. So what is this 125 into? Okay, first we have to go to the future and see what is the future price. It is 125.2 if you see here. Okay, so 125.2, wait a minute. Okay, 125.2. So 125.2, okay, that is the opening plus 1/7. Why 1/7? Because it was for 6 months we have to hedge, but we have taken a 7-month expiry, so that 1 month is unexpired. So that's why it is total is 7 months. We have taken a 7-month expiry, but out of that 1 month, only 6 months is hedged. 1 month is remaining. That's why it is 1/7 into, okay, the difference between this and this. The difference between the 4-month expiry and the 7-month expiry. 4 month was 120, the previous one 129.2, and using that 7 month it is 125.2. So the difference, and you are getting 125.8. So wait, 129.2, I guess that is the spot rate. I'm sorry, let me check. Yes, it is the spot. I'm sorry, you have to take spot and future. Okay, in the second method you have to take this one. In the first method you are taking the 4-month expiry, 129.2. Okay, yes, that's why you take 120, the spot minus the future, into 1/7 plus the opening future. You're getting 125.8. Now let's see the first method. First method also same, 125.3. Okay, and this 1/3. How is it 1/3? Okay, for that will come later, but let me explain this. This 126.9, they have taken the 4-month expiry. 4-month expiry minus the 7-month expiry. Okay, into 1 over 3. How they got 1 over 3? Because here they are comparing with the 4 month and the 7 month. Okay, so 4 month versus 7 month, the difference is 3. The 3 month, out of that only 1 month is unexpired. It will be 1 month only which will be unexpired. Okay, so the up numerator will need change or the denominator. Now it is for 3 months because we are comparing 4 month and the 7 months future price. That's why it is 1 over 3. But the price, if you see, closing is 125.8 under both. But in the textbook, when you learn, it is the second method which we learn. But first is also fine. Number of contracts sold. What is the price of the euro? It is 80 divided by the contract. So 640 exact. Whenever it is an exact amount, it is better because there is no problem of under hedging, over hedging, using the forward and all those things, right? It's easy. Calculation is easy. Next is expected receipt from sale. Next is you just convert. So 125,000 is the size of the contract into 64 contracts into 125.8, which is your closing future price. This is the reason you need to find that closing future price, because you want to find the expected receipt using your future. For that, opening future will not help you. Closing future you have to find. To find closing future, you have to know your basis risk, how you calculate this. You have to be good at this thing, and also this formula: spot minus closing opening future price. Otherwise, you will not be able to calculate closing future price, because if you find your closing future price, okay, if it's wrong, then your expected receipt from sale also will be wrong. Based on that, everything else will be wrong. So this is it. In Japanese yen, okay, currency is very important. If you check with your forward, okay, and future, it is 10,024, whereas in future it is 10,064. So that means future is giving you a better. So that means forward is out of the option, because we have to find which is the best. Now we have to compare future with options. Let's see option. So option, don't go and waste time again. Smart candidates will be able to figure out that the number of contracts will be same under options and future. Till now, I have never seen a single question where contract size of future and options are different. It will be same only always. That you can be sure of. So the contract, number of contract, whatever you calculate under future, same you can use it in option also. So time is saved. So 640, and also it is 7 month. That is same. Whether put and call. Okay, don't say put because the answer is put. You have to understand the logic why it is put. Okay, this is an option to sell. We are selling euro, and the contract size is also in euro. That's why it is a put option. Okay, because this is a foreign currency receipt. We are selling it, so it's a put option. Okay, put contract option will be purchased to protect against the depreciation of euro if options are exercised. We always assume options are exercised only. So if options are exercised, what is the contract? Same only, 125 into 64 into 126. 126 is the exercise price. Okay, now premium. We have to find premium also. Additional thing in option is premium. In future, we don't have premium. Now, premium, you have to be very careful. Why? See, this is exercise price, okay? That's why we multiply by 126. Now, coming to future. So, wait. Put. So, put, it is 7 month 3.8. Okay? But 3.8 means what? It is always divide your premium by 100, because it is cents per 1 pound. So, it will be 3.8 divided by 100. Okay? That means 0.038. That will be your premium. You have to convert this into what? If you have to convert this into Japanese, you have to use which? Spot rate. You have to convert using spot rate, because premium does not depend on exercise price. Whether you exercise the option or not, premium you have to pay in the beginning. So you have to use spot rate to convert. Which one? 129.2, 132.4. If you are saying 129.2, you are very wrong, because premium is a payment. It's not a receipt. So payment and receipt, you have to use opposite rate. This is a foreign currency receipt. For receipt, we are using 129.2 spot rate. We are using spot rate. But Premium is a payment, so we have to use this one, 132.4. That is the catch. But okay, 132.4. So let's see. But here we don't have to convert that because it is already in Japanese pound. So 3.8 into 125 into 60/40, it is in Japanese yen. You don't have to convert again. So this, okay, euro minus your premium. Premium will be deducted, this one. So option is giving you the lowest receipt. So which one is your option? Which one you should go for? What is your conclusion? Usually in your report, when you write conclusion, we say advantages and disadvantages and sensitivity analysis. As to here, we are not doing this. Here, we only have to select one. So it's very easy. Conclusion is very easy. Future contracts, future is your option. Gives you the highest receipt. Why you are selecting future? You have to write because it gives you the highest receipt and will therefore be used to hedge the expected euro receipt. Now, what is the receipt invested? So this receipt which you are getting using future, you are investing in the airborne project. Now you can shift your thinking to an airborne project. So invested for further 6 months still needed for the Air 1 project. Remember, this will be invested for another further 6 months, they told. What is it in options you are getting? 10,064 million. So this 10,064 million into the rate. The rate. Okay. What was the rate? What was the rate? It was 1.2% annualized. I underlined also. Here. Yes, somewhere I have underlined it. It's not here. Yes, this one. Annualized yield on short-dated Japanese treasury bills 1.2%. This 1.2% is annualized. You have to find for a number of months. So you are investing it here. Okay, here they have clearly told. Wait a minute. Yes, here. So the company is due to receive the proceeds from sale of European subsidiary in 6 months' time, and it will then invest this funds in short-dated treasury bills for further 6 months. For further 6 months, it will be invested before they are needed for the project. That's why first you have to invest, and then you have to use it for the project. Don't start using for the project and then invest it. That sequence is very important. That order, what you are doing. So 1.2% is annualized, and you're investing it for 6 months. That means you have to find for the number of months. 6 months you have to find out. Okay, if you see here, they have divided it by 2. Why? Because 1.2%, if you are taking, it will be 0.012 into 6 over 12. So if you simplify this, it will be 1 over 2. Okay, in other words, 0.012 divided by 2 only. So that's why they have taken it divided by 2 plus 1 into that rate, and you are getting this. Another trick is here. What is it? You have to find what? What do you have to do? Do we have the rate of Japanese yen ARD? Let's look. We need that exchange rate between the two countries. If you see here, we are given the Japanese and the euro, we are given the ARD and the euro, but are we given the ARD and the Japanese yen? That exchange rate. Exchange rate is not given to us. So how do we find out? We are given 3 currencies here. Euro, Japanese yen, ARD. Now how do we find out? Spot cross rates. Spot cross rates. Spot cross rates. You have to find. You are using through another currency you are finding. Okay. So it is 0.7, 0.4 ARD per Japanese yen. Now how did they get that? How did they get that? By using this. Okay, we'll see what is this 92.7 divided by 132.4. Okay, so forget about the forward rate, just look at the spot rate of the two. This one and this one. This is A, this is B. We have to find ARD for one Japanese yen. So how do we do that? Okay, the rates which you pick out, it has to be different rate. If you are using 92.7, then this has to be 132.4. It cannot be 129.2 because you are buying and you are selling. Okay, so ARD divided by JPY. Okay, so 92.7 divided by 132.4. Why is it? Because we have to buy and we are selling in one currency. Okay, to get euro, understand this thing. Don't just memorize it. It will not help you. What do we need? We need ARD. Okay, so for that we are receiving euro. First we have to sell our euro to get ARD. Okay, airborne currency, airborne rent. To get that, we have to sell our euro currency first. So we are selling euro currency at what rate? At this rate. At this rate, we are selling euro currency 92.7 to get ARD. Once we sell and get ARD, what should we do? What should we do? We have to buy euro to get Japanese yen. Okay. At this 132.4, that's why we're taking 132.4. We need to buy Japanese yen after we sell euro. So we are buying at a higher rate, 132.4. We are buying at this rate. That's why it is 92.7 divided by 132.4 or 95.6 divided by 129.2. Okay. So it will be like this. Spot cross rates. ARD per 1 Japanese euro. Okay. This. Now you have to decide 0.7 or 0.74. Which rate you are taking. That you have to decide. Expected ARD divided by ARD JPY conversion spot rate in 12 months. In 12 months you have to find. How are we going to find 12 months? In 12 months? By using inflation rate, purchasing power parity. Right? So the inflation in airborne was 9% divided by 1.5% in Japan, the inflation. Okay, they have taken 0.7, this rate. Okay, because we have to sell Japanese yen. We have to sell Japanese yen to get ARD. So we are selling at a lower rate because we had a worse situation always. So that's why it is 0.7. You have to sell Japanese yen to get ARD. and for 12 months. So this is the rate. We need this rate. So now, what is the additional debt finance needed to fund the AR1 project? Investment amount required. Now, you are using this rate so that you can convert into Japanese yen. Okay. What is the investment amount required? What is the total investment? This 10,150, this amount, this is the investment. This you have to convert to Japanese yen. For that, we did all this cross rating and found the rate. So this you have to, it is in ARD. You have to find in Japanese yen. So you are now dividing it by 0.75 because it is in same currency. So you can have to divide 10,150 divided by 0.75 in Japanese yen. This is your additional finance required. But investment amount required, debt finance required. Out of this, how much debt you need? This is your total investment, but you are not taking all this by through debt because you are getting your receipt also. Remember the European receipt? So what was your European receipt? Total investment is this much. Out of that, what is your investment receipt after investing for further 6 months? It is this amount. Don't go and take the future one, okay? Because that you have invested for 6 months. After that you have to deduct. So this is your additional amount which you need through debt. That also has to be in Japanese yen. Okay, that's why we found this 0.75 to get it in Japanese yen only. The whole purpose of that is to get it in Japanese yen. That's why we did all this spot cross rate. Now coming to Appendix 2. Air 1's project net present value. Okay. Now this question, if you see, okay, this is an Appendix 2. Okay, part C, the second part. Here we are not starting with sales, then deducting cost and all those things. Why? What is already done? We are starting with what? We are starting with the cash flows in ARD in millions. This was the investment. If you see all this, let's see. Let's see the table. This amount only they are taking. This amount is only going there. Cash flows. Okay. Now, this cash flow is in which currency? ARD. You have to find what? Japanese yen. How you will convert? For the first year, okay? It is starting from year 0. It was 0.75. We have found out. Now using this 0.75, we have to find for next one. How are we going to find? Simply multiply 0.75 by the inflation. What was the inflation of airborne? 1.09 divided by 1.015. You will be getting 0.81. On that, again, inflation, this. So these are the rates you have to make sure that you are getting these rates. Okay. You might be getting a bigger answer, but you are rounding up to 2 decimal places. Now in Japanese, what are the cash flows? So it is in, you need to divide this 10,150 by this, or this 2530 by this. You need to divide it because it is in same currency, and then you are getting this cash flow. When you're coming to year 0, be careful. Even here also, usually it's the same, right? No discounting matter. But here we are assuming that year 0 is year 1 only. Okay, that's why we are taking it. We are using that year 1 for year 0. Assumption was there. So cash flows we are having for year 0 also. Okay, that is the investment, cash outflow. And then lost contribution. What was the lost contribution? 110 for year 1. From here onwards, you have to increase it by what? By the inflation. What was the inflation? inflation was 1.5%. So 110 into 1.015. You have to keep on increasing by 1.015 every time. 112 again, increase it by 1.5%. 113 by 1.15%. So round it up to the whole number. This should be your loss contribution because it will be inflated by the Japan's inflation rate. This is in Japan is yen now. Don't go and put air bonds inflation rate here, 9%. You have to be very careful which inflation you are taking and which currency it is. This is now Japanese yen. Now, tax saving on lost contribution. When you're losing contribution, aren't you saving tax? Because when you're making a contribution, you have to pay tax. But when you're losing the contribution, you're saving tax. You don't have to pay tax. So that tax saving you have to calculate because your cash. Okay, everything that has an impact on your cash flow has to be there in your net present value calculation. So tax saving is one of it. Okay, 30%. What is your lost contribution? Just see your lost contribution on that. Just apply 30% because 30% is the tax. Okay. So 30% of 110, 30% of 112, like this you'll be getting all. Okay. Now, contribution component. Working 2 is there. If you see, working are never done in the main table. It should never be done. I know it is in appendix. Appendix is a kind of working only, but still, there were a mini separate working somewhere else. Okay, for contribution component working 2. So for that, we have to go to working 2. From here onwards, you have to stop. That's what you have to do in the exam. Whenever you have such part where working is required, stop there, leave space or leave one whole page and go to the next one and start doing working there. Don't proceed to the next step because next one is tax on component contribution. For that, you need to do your before step. Otherwise, you cannot find tax. Okay, working 1 has been done for you, right? This working 1 has to be done because you are predicting inflation rate, exchange rate. Coming to working 2. Okay, the component contribution. So for component contribution, what do you need to do? You need to find the revenue on that. Contribution is 25% of the revenue they have told. So, and it is post inflation that you have to find out your revenues. So first you have to find your revenues for all the 4 years and contribution is just 25% of that. And this contribution only will go to the table if you see 300, 609 and all. Let's see the table. Yes, 300, 609, 644 and 79. So now let's find the sales, the component, the revenue. Okay. Sometimes what you are done is you are given the cost and you are given the sales. So just sales minus cost, variable cost is your contribution. Sometimes you're not given the cost, you're just given the sales and on that they tell that this percentage is your contribution. Like in this case. You should know both the methods. So coming to the contribution, if you see this are the sales. 1200, but this is what? This has to be 1200 only. Why? Revenues are increased from year 2 to 4 only. That means when you're coming to 2400 multiply by 1.5%. Japan is inflation rate. Okay. That's why if you see here, it is 1200 only. It didn't change. It will not change. You're changing from second year. Okay. So let's say second year will be 2400 into 1.5%. Then third year. When you're coming to the third year, what you have to do is, okay, I'm just showing you here. It was 2500. Okay, before inflation. It is 1.015 to the power of 2. Okay, this will be 2400 into 1.015 to the power of 1. Because from your year 2 onwards you are increasing. Okay, and here when you are coming, it will be 300 into 1.015 to the power of 3. That's why you are getting 314. And contribution is this stack. Now, tax on component contribution. It is just 30% on 30% on what? 300. 30% on 609. So just on this you have to take the tax. Next, additional tax payable. Working 3 is there for additional tax payable. Why additional tax payable? Why additional tax payable? Because you are tax saving on the loss contribution. No, I'm sorry. No, it does not come. I'm sorry. Additional tax payment is this 15% because of the double tax treaty. Okay. Let's go to working 3. Okay. Before that, first we'll see the tax rate of the two countries. In Japan, it is 30%. In airborne, the tax rate is how much it is? 15% if you see. You see? 15%. So your additional tax can be offset because it permits offset of overseas tax against any Japanese tax liability on overseas earnings. 15%. Okay, so it will be offset. Okay, so when you're coming to working 3, pre-tax profit. Okay, and it will be 15%. Whatever you're getting in ARD, the revenue is there, the profit there, before tax, that on that you have to find 15%. What is the pre-tax profit? So here we are not given the profit, we have to find the profit. Okay. Yes, these are the profits we have to take. Okay, pre-tax profit. So on this, those are the pre-tax profits you have to take. On that you have to pay additional tax payable at 15%. So you need to convert this into Japanese yen. How are you going to do that? 1800 divided by 0.81, because in the first year it was 0.81. This exchange rates, okay, this exchange rates you have to use from year 1. Don't take from year 0. This is from year 1, and then year 2, year 3, year 4. Okay, and multiply by 15% because tax. So this, okay, 333, 966 and all will go here, additional tax payable, which will be deducted. Next we have net cash flows, and then discount factor is 12%, so using discount factor find out, and then the expected net present value is in negative in Japanese yen and also in million. So it is in negative, it has to be in bracket. So let me see whether all the workings are done or not. It is done. Now I am in a position to write the report. As you can see, it is negative. So what am I going to write? The debt finance. How much it is required? 3408.6. See the introduction. So I'm going to go to my working and see. Yes, this was the debt finance required, and this was the one which is there in your introduction. Now let's go to our evaluation of preferred hedge. So the income from the sale of European subsidiaries is maximized when future contracts are used. Future. Therefore, these are chosen as Washi will borrow the least amount of debt finance as a result. Okay, you have to tell this point. This is the reason why you are going for that hedging choice. Why? Because when you choose future, you have to take the least amount of debt under this condition. However, compared to the forward contract, futures are market. Now it is evaluation. Evaluation means what? This evaluation says you have to give disadvantages also, even though you have selected future. So when you are giving disadvantages of future, it is not just disadvantages. You need to compare this with forward and option. That is what is evaluation comparison. So compared to forward, that's why it is compared to forward dated. Okay, futures are marked to market daily. That means compared to forward means in future it is there, in forward it is not there. So marked to market and require a margin to be placed with the broker. This could affect the Washi company's liquidity position. So liquidity position, whose liquidity position is affected? Washi companies. The assumption has been made. See the assumption. I have told you. This is what I'm trying to tell you. Assumption is everywhere, especially in part A, section A of your question. Whether they tell you to state or not. Most of the time they will tell you to state. 90% of the time it is told that state assumptions and all. So assumption has been made that basis reduces proportionally. So what was the assumption about the basis? That it reduces proportional as the future contracts approach expiry. That means the more the future goes towards the expiry, your basis risk keeps reducing until it becomes zero. If the option, okay, let's say a future option, future you are taking is for 3 months and your hedging period, you need to hedge also for 3 months. You're exactly hedging it perfectly, you're using the future for hedging. That means there is no expiry, it will be zero basis risk. In that case, it is just the difference between your spot and the opening future price. That will be your closing future price. But in most of the time, okay, I have never seen a question where it is the basis risk is zero. There will always be some basis risk. That means your expiry to future, the duration of the future which you are taking in a hedging period is different. That's why that basis risk is there. Okay, but there is no guarantee that this will be the case. Therefore, the basis risk still exists with future contracts. You have to talk about basis risk when you're talking future. Although forward contract gives, now you're bringing forward. Now see how you're linking. See that flow. It started with future. Next, it is going towards forward. So this link has to be there. So although forward contract gives a smaller return, there is no basis risk and margin requirements. However means what? See this however, but, in spite of, despite of, in case, these are your connecting words. You are connecting like this. You told these are the advantages, but even then, on the other hand, these are the disadvantages. Like this, you have to answer. They do contain a higher risk of default. Higher risk of default is there in what? Where? Okay. Higher risk of default is there in forward, as they are not marked traded. Option gives. Now you see next. See the link. Next, they are going to options. So here. A means advantages, D means disadvantages. Okay. This is how it is going. Now options give the lowest return. So option is giving you the option is giving the lowest return, but would give Washi company the flexibility of not exercising the option should the euro strengthen against the yen. Flexibility is there. If euro strengthens against the yen, make sure that you know this. What happens when euro strengthens and when happens when euro depreciates against yen. I think I have explained this in my most of the videos where I explained depreciation and appreciation of a currency compared to another currency. So I'm not going to repeat this in this video. Just make sure that you have watched my before videos where I have exchanged this with an example using some numerical examples. Option flexibility is there that if exchange rate is going against you, you can hedge. But if it is going in the favor of you, then you can take that advantage of not exercising the option. But it is not available in forward and future. You cannot take the benefit. So although the euro 80 million received from the sale of subs has been agreed, there may be a risk that the sale may fall through or the funds of some proportion of the funds are not received. So this is another issue which could be there. that maybe that 80 million, maybe you might be getting less than that, not the whole amount, or maybe the sale might have got cancelled, or many things might have happened. Okay, washing company may need to assess and factor in this risk, however small it may be. The amount of interest on deposit is based on the next you are talking about what? Interest on deposit. This connection, this link has to be there. How you go from one line to next point is very important. So the amount of the interest on deposit is based on the current short dated Japanese treasury bills, and the estimate of the borrowing requirement is computed from the predicted exchange rates between ARD and JRD in a year's time. Basically, whatever you have done, you are explaining in words only. That you have used this exchange rates to predict the ARDs and this one's rate, okay, the borrowing requirement based on the purchasing power parity. Both these estimates could be inaccurate if changes occur over the coming months. Although insignificant information is provided for a financial assessment, okay, very not much information is provided on this, very insignificant. Washington should explore the possibility of converting euro into ARD immediately on a receipt and keeping it in an ARD bank account until needed, instead of first converting euro into Japanese and then into ARD. Okay. So this, okay, I'm whole thing I'm including because this is something new. How you convert one currency to another. They could have converted euro into ARD and kept it in ARD bank immediately, rather than using that spot cross rate, rather than converting ARD into Japanese and then converting into ARD. Twice you are converting it. Using debt finance. Now, next is debt finance. Okay, where's that table? Debt finance. So using debt finance to make up any shortfall in the funding requirement may be appropriate for Washi, given that it is an unlisted company, and therefore access to other source of funding may be limited. See, this is why I told you that always underline or highlight what type of business the company is in. Is it limited? Is it public? It is private? Is it small? Is it big? Or is it multinational? This unlisted company. For them, debt finance might be a source of finance. Maybe other sources of finance are not available for them, like a listed company would have. So nevertheless, Vashi should assess how the extra borrowing could affect any restrictive covenant placed on it. See, when you're talking about extra borrowing means restrictive covenant, you have to talk about it. It is linked. And the impact on the cost of capital, again very important. Debt you are taking, cost of a capital will have an impact. Since the amount seems to be small in the context of the project as a whole, this may not be a major problem. This is based on your thing you have to tell. Just see how they are giving it. The amount is very small, the debt finance which is required compared to the project, so this might not be a major problem. Sometimes, okay, so just because it is not a major problem here, don't go and memorize this line and write in your paper. Maybe in your paper, the debt finance required might be bigger. So there you cannot say this. There you have to say that it's a major problem because debt finance required is big. When it's a very big amount, a substantial amount, the debt finance, then it's an area for problem. Washing company should also explore whether or not investing in the AR1 project restricts his ability to fund other projects that affect his ability to continue normal business activity, especially if washing company is facing the possibility of hard capital rationing. Hard capital rationing is what? Limited. Their capital investment is limited. They cannot invest as much as they want as the way they like. It is limited. They have limited funds. Their budget. So they cannot invest. It is limited, right? They have to see if they invest here, will it limit their potential to grow or expand into other markets or other investments? Can it be done or not in the future? So all this has to be looked into factor, and all these factors only you need to talk in your report. You need to write. So when you prepare yourself also, don't read answers like this and don't say okay I know this is very easy. I know this to write in report. Until you don't write in your own words in the time limit, you will not understand it. You will never understand how to write a report. Trust me, it looks very easy to read, but when you go to write, then you will understand the real struggle behind this. You will end up writing too less, either you will end up writing too much. There you will know what are your shortfalls, where is your weakness. Are you fast in doing calculations? Are you able to handle big calculations? Are you able to switch from one place to another very quickly? Then you will understand. That pressure you need to feel, because on the exam, when you're sitting for the real exam, you will be feeling the pressure. You have to be exposed to that pressure. So don't just be relaxed and calm and just reading the answer and memorize and think that you have done a wonderful job, you have done all the questions perfect, everything. Go to the exam hall very confident. I have answered the paper beautifully and I'll be passing the paper. And when you see your result, you'll be the one who will be the most surprised one. So don't let this happen. Okay. Evaluation of the one project. Now you're evaluating this project. For this project also there are so many assumptions out there which you have to tell. So whenever this thing is the evaluation of this project, the first thing what you have to write, what is the most significant is your net present value, that it was negative. That is the first line. So the net present value of the A1 project is estimated to be this in Appendix 2. When negative net present value happens, what do you have to tell? You know the next line is what. So given the negative net present value, initial recommendation, it is initial. It is not final recommendation. Because you should never say someone that you have to accept this project, must accept this project because it is positive net present value, or you should definitely reject this project. No, your words should not include this words, ignore these words. Definitely, certainly, surely, must, no. So initial, okay, initially, yes, because there might be other non-financial factors. Maybe because of that you might recommend them later to invest. You don't know. So initial recommendation would be to reject the project. However, given that the project result is marginal, see the result is very marginal. If you see that it's just 457 million, it is not in some very big numbers and all. Washing company should consider the following factors before rejecting the project. What are those factors? If you see the factors, it is given in different paragraphs. I can see there are 4 different paragraphs. That means there are 4 different factors. So at present, Washing does not have a significant presence in the part of the world where Avon is located. This is the first thing I underlined. Significant, does not have significant presence. The Washi does not have significant presence where Avon is located. So taking on the project may make good strategic sense. Good strategic sense is one reason why you are recommending that they should take this project and provide a platform for Washi to establish his presence in that part of the world. Second, furthermore, once Washi has established itself in A1, it may be able to develop further opportunities and new projects. Yes, further opportunities and new projects. It is not just they are going to go only for one project. Maybe there might be further opportunities which might be coming in that country or new projects. So the value of this follow-on options. See, whenever you're talking about net present value, investment in a different country, always bring this topic of real options or follow-on options, the same thing. So the value of this follow-on options has not been incorporated into the financial assessment, where she should explore the possibility of such opportunities and their possible value. That value is also needed. It is a real option only, follow-on options. Financial assessment ends abruptly at the end of the 4 year. No indication is given on what would happen to the project thereafter. They just told 4 years. After that, did they tell anything? No. So it may be sold as a going concern, or if closed, its land and assets may be sold. Cash flows from this possible course of action need to be incorporated in the assessment, and this could make the project worthwhile. A number of assumption estimates. If you see this last paragraph, assumption and estimates you cannot skip at all. I'm telling you this again and again, because people always miss out on assumptions and estimates. Thinking is not very important. It is very important. So a number of assumptions and estimates would have been made in the financial assessment. For example, the rate of inflation. Use for future figures the current rate, and the tax rate used in the tax rate used is the current rate. So tax rate is another one. And this may well change in the coming years. See, inflation and tax, we know that it will change in the future. But we have predicted using current inflation and current tax rate. So that is one estimate. Therefore, it is best to undertake sensitivity analysis, another term where you cannot skip, and produce a number of financial assessments before making any firm commitment to proceed with the project of deciding or to reject it. See how they are giving the conclusion. Don't just see the answer. The way they are saying, they are not very sure. They are not saying reject. They are not saying don't reject. They are saying Before making any final commitment, go through these factors, look at this factor, and then decide whether you have to go with the project or not. So when you're giving your conclusions or recommendations, this is the nature, this is the way you have to give. You cannot be very sure, you can never be very certain until reject 100% or don't reject. Now let's see conclusion and recommendation. So the income from the sale of European subsidies is maximized when future contracts are used. Again, this line is repeated if you have seen. Okay, because in conclusion, it is just the summarization of all the points what you have discussed till now. So, number one, sale is maximized. As income from sales of European subsidies maximized when futures are used. Number one, you have to say in your conclusion. But Vashi should weigh, okay, even though you have to tell that the company should weigh this against the benefits and drawbacks of all hedging instruments before making a final decision. See how they are giving conclusion. They're always not giving one thing. It is not clear cut. Never it is clear cut. They're always saying that, okay, feature is good. It is used. It is beneficial. But check out the benefits and drawbacks of other options as well before making a final decision. Although the project is current, it is in different paragraph. Hedging thing is in the first paragraph. Second thing, they are talking about net present value. Although the project is currently giving a negative net present value, and rejecting it at the outset is premature. See, rejecting it at the outset is a premature decision. It is not a very mature decision. So a number of factors discussed above needs to be considered and assessed before final. Again, you see, same conclusion. Okay, factors needs to be considered, assessed before final decision is made. Sensitivity analysis would be very helpful in this respect. Always conclusion includes sensitivity analysis. Okay, this is the points, additional points. See, in any video, no one will ever tell you, do this for conclusion, write this for conclusion, write this way for conclusion. They might just give you some answer. That's it. They will only explain you the concept. They will never explain you this little details of answering a question. So all these tips, all this way of answering you will only get in my channel. I'm very sure about it. Because that's my nature, you know. And a student has the right, they should know each and everything, not just the knowledge part, not just from the textbook, the theories and the calculations. They should know all this. Finally, Washing should consider alternative uses for the funding which it will be dedicated to the project. These alternative uses for the finance need to be considered before any decision is made, especially if Washing is facing the possibility of hard capital rationing. Yes. So alternative use of finance, that is the third. Now, we are done with it. Now we are coming to part D. Okay, I'm going through part D because it's very important. Few scenes. Okay, we are given the benefits of centralized treasury department, and also we are given the benefits of decentralized or separate treasury department. It is known as decentralized only. Make sure that you know. Okay, before that we'll see what it is. It is difficult to conclude definitely whether centralized is beneficial or not in all circumstances and for all companies. It is difficult. You cannot say specifically that this is only beneficial or not. In some circumstances, yes, it is centralized. In some circumstances, it is decentralized. It depends on each company itself and circumstances it faces. Vashi should take this into account before making a final decision. So, what are the benefits of centralized? Let's see. There, I can see there are 3, 4, 5. Okay, 5 benefits are given. Having a centralized treasury management function avoids the need to have many bank accounts. Avoid many bank accounts and may therefore reduce transaction costs and higher bank charges. So reduce transaction cost, higher bank charges. That is one advantage of centralized. One bank is enough. So transaction cost reduces, bank charge reduces. Large cash deposits may give Washing access to a larger, diverse range of investment opportunities and may be able to earn interest on a short-term basis to which smaller cash deposits do not have access. Say large cash deposit is available. For that, they can earn a huge interest. But in short-term basis, it's not possible. On the other hand, if bulk borrowings are required, it may be possible for Vashi to negotiate lower interest rates. We know bulk, the advantages of bulk buying. We get discounts. No? So same way, for bulk borrowing, we get lower interest rates. We can negotiate, which would not be available to do on smaller borrowings. Yes, when you're going for a decentralized, we are not getting this large amount of borrowing. We can only go for the smaller borrowings. In there, we cannot demand for low interest rates, negotiate. So this is number 1, this is number 2. Number 3, this is for 7 marks, right? A centralized treasury function can offer the opportunity for fetching to match income and expenditure and reduce the need for excessive risk management and thereby reduce cost. The excessive risk management is reduced. Why? Match income and expenditure. Number 3. Number 4. A centralized treasury management department could hire experts, with smaller diverse treasury management departments may not have access to hire experts. We know the quality of experts, right? When expert is there, the quality of the work increases. Your risk management, your working capital management, your liquidity management, see, all these are functions of treasury department. So when you're having a good quality staff who are experts, your quality increases, your work performance increases. So also your cost will reduce. These are all available in a centralized treasury department, not in decentralized, because it is small, right? They cannot hire experts. So this is number 4. Number 5, a centralized treasury department may be better able to access what is beneficial for Washing as a whole, whereas local treasury functions may lead to dysfunctional behavior. See, local may lead to dysfunctional behavior, but centralized will always look for the benefit as a whole. Okay, coming to the separate decentralized treasury department. If you see, there are 3. That's how you are getting the 7 points. So it could be argued that decentralized treasury departments are better able to match and judge the funding required with the need for the asset purchase for investment purpose on a local level. Better able to match and judge the funding required for asset purpose on a local level. Now in this case, okay, when you have to purchase an asset for an investment purpose on a local level, that time decentralized is better because it is not such a large amount is not needed specific for that investment, which could be better matched and judged. Okay, the decentralized treasury department, they can judge how much it is required. Therefore, and also it is quick, so they can respond also fast. Centralized, it will take so much of time because one department is only taking care of everything. So therefore, they may be able to respond quicker when opportunities arise, and so could be more effective and efficient. Number 1. Number 2, individual departments within a subsidiary may have better relationship with the treasury departments of that subsidiary and are therefore able to present their case without lengthy bureaucratic delays. Yes. Number 3, ultimately the benefits may be implicit rather than explicit. Having decentralized treasury departments may make the subsidiary company's senior management and directors more empowered and have a greater autonomy. They will have greater autonomy because they have a say in that, right? The directors and the senior manager, they will be empowered, they will be having greater freedom, and so this in turn may increase their level of motivation, and as they are more in control of their own future, resulting in better decision being made. All this are from your textbook only. Make sure that you go through treasury, that is chapter 15 in your AFM BPP textbook. Make sure that you go through this. But for your new AFM revision study textbook for BPP, the chapter number might be different. Okay, so make sure that you have the right. The one which I have is till June 2019, from September 2018 to June 2019 textbook, BPP textbook of AFM. In there, chapter 15 is for treasury. For the latest one, the chapter number might be different, but make sure in treasury chapter, treasury management chapter, you go there and learn the roles, advantages and disadvantages of centralized versus decentralized, main things. So that's it for this. Let's go through the marking scheme now. If you see point A, what was point A? Part A, it was about international investments advantages versus domestic investment. 1 to 2 marks per valid point. 5 marks are there, so 5 points. B, advantages and disadvantages of exchange traded versus over the counter. Okay, coming to point C. C is very important, right? Appendix 1, amount to be received based on a forward rate. 1 mark. Which amount is that? Okay, so forward rate, that amount is 1 mark. Decision to go short on future, another mark. You have to say, and basis is 1 mark. Amount to receive, the closing future price, based on that price, whatever the amount you're receiving, another 1 mark. Decision to purchase put option, 1 mark. Premium payable, another mark. Amount to receive based on option is 1 mark. Select. If you're selecting future, another mark. And Japanese yen receivable following further 6 months of investment. Estimate of current cross rate. So if you're estimating that cross rate, also 1 mark. In 1 year's time, estimate of the rate and the debt borrowing required. Next, Appendix 2. Appendix of this, estimate of the future rate, the lost contribution, the tax saving and loss contribution, the contribution from sale of components, the tax on contribution from sale of additional tax payable in Japan. Okay, you have to pay additional tax payable in Japan, that 15% in air bonds, that pre-tax profit, okay, and the present value, the net present value. Next, here, report. Evaluation of head choice and debt, 3 to 4 marks. 3 to 4 marks. You cannot forget, miss this marks out. Evaluation, just for evaluating. Evaluation of Air 1 project, another 3, 4, 2 marks, and conclusion is 1 to 2 marks. Coming to part D, 3 to 4. Centralized and decentralized, 2 to 3. And the overarching commentary, that 1 mark is for the commentary. What commentary? You have to say whether it is valid, the CEO's comment, it is valid or not. That is not given here, okay, but you have to tell whether it is valid or not, because it is up to you. You have to tell it. So that's it for this question. Next question will be 54. Don't forget to subscribe to my channel and practice, because practice makes a man perfect. Yes, you have got it right. So that's it. Take care and see you in my next video.